Thank you for joining iMeet. When you hear the tone, you will be the 20th person to join the meeting. This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. And today we're going to quickly review the last couple of days, take a look at the market, some different indexes and sectors. A couple other different charts that we haven't looked at for a while. I usually talk about 20 or 25 minutes if this is your first broadcast. And then we open up to questions and we try to keep it under 40 minutes, but sometimes they go a little bit longer than that. So welcome and let's get started. We've covered about 2,000 points in the Dow Jones since the S&P 500 bounced off its 200-day moving average. In fact, just in the last 3 days, not counting a little bit of weakness today, we picked up about 900 points in just the last 3 sessions. So it looks like we're going to have a V-shaped recovery, which I was hoping we weren't, but looks like we will anyway. Usually when you have at least a 10% correction, it takes about 54 trading days before you make it all back. We could be hitting the old highs here as early as next week, it looks like to me. I'm not sure. The NASDAQ's right now is within about 85 points, or at least it was earlier today, from making those old highs. So we need a little bit of consolidation today, which is good for the broader market. We don't just want it to go straight up and be as overbought as it was before. So anyway, let's get started, and we'll take a look at the Dow first. I'm going to look at some different things on here. The first thing we'll talk about the Dow is the CTI is a +1. That means we're still bullish. Now, unfortunately, with a forecasting tool like the CTI, occasionally you have to reset because nothing's perfect, and sometimes you'll have we were probably looking more for a pullback. About 2 weeks later, 3 weeks later than where it actually happened. So what we'll have to do is I'll have to go back and reset some of the cycles to this week from 2 weeks ago. Then we'll move forward. Now, if we continue to go strong the rest of the week, the momentum index stays positive or bullish, then the cycle that will started there. We'll be moving forward and we'll remain bullish. So at this stage, that's kind of what looks like it'll happen. We should have gone, this would have been the negative pullback, but like I said, I was looking for about 3. The cycles looked like it was going to go about 3 weeks further out, and they didn't. So now if that ends up being the bottom, then we'll go ahead and we'll probably go bullish and stay bullish again into the summer. So keep that in mind. Don't be jumping on any of the triple leveraged negative things, and I wouldn't buy the long ones yet to see just what happens in here. Okay, momentum index is neutral. That's because the Dow Jones is still outperforming the other indexes. Sentiment is also neutral right now. That's because some of the bullishness has been reined in. About 2 weeks ago, we had percentage of bullish investment advisors was up around 66, one of the highest levels that have been for a while, and now we're down to about 48%. We get a new one out tomorrow, so we'll see how that is. Now, one of the things I've done with my Fibonacci retracements is I've gone back to where we started to go parabolic over here in November. And what you see now, yesterday, the Dow Jones, or actually last Friday, it closed above the 50-day moving average, gapped up and went ahead yesterday. And we're kind of going back and forth, doing a little bit of filling right in here. But you can see on this thing, we've already retraced now 61.8% of the whole move down from where we were the 1st of February all the way down to this sell-off area over here. So coming back, normally what will happen when you have a quick, like a V shape like this, once you cross above that 61.8% retracement level, you're normally going to recover the whole thing. So I just think it's a matter of another week or two, and we'll be up here bouncing across, with our sights set on the old highs. Things could change, and we'll get into that because all this movement is based upon what's going to happen with the yields. But anyway, here's the NYSE AD line. Again, we look at this as kind of a leading indicator for the market, and this thing is showing some pretty good participation. One thing that is a little bit troubling is this. This is the NYSE new 52-week highs versus new lows. Of course, we're well off the old high there for a while. But you just started to see a little bit of expansion in that. Today we're almost at triple digits again on both indexes. So we should start to see this get up here over the next couple of days up around 150, 175, 200, and that would mean that we're getting even broader participation. What we're seeing right now, especially in the NASDAQ and even in New York, you're getting a lot of the movement out of some of the really big cap names, the Boeings and even in the Microsofts and Apple and that kind of stuff. Apple's having a pretty good day. That's because of especially with the Dow, how it's weight priced or priced by dollar. That's why you're seeing that outperform right now. But this, we want to watch this, and this is on the market recap on the market site. And you want to watch to see if we're going to get some expansion in this thing. All right, here's the S&P 500. A couple things with this. A couple of weeks ago, we talked about that the S&P 500 was as overbought as it had been by some standards measures in like 22 years. One of those standards is this line right here is a 200-day moving average. And when we got up here, we were something like 14% or something, or 50% above the 200-day moving average. Normally, anything over about 7.5 to 8 is considered to be overbought. Remember, we've talked before about taking our thumbs and forefingers and measuring from here to here on one of the moving averages. And when you get when it starts to get too far away, you can tell you're getting over too bought. It should come back down to that level. Right now, as of yesterday's close, we were 8.7% above the 200-day moving average, so we're overbought by that measure again. Also, the S&P short-term oscillator yesterday hit 5.7. That's some different indicators we look at. Jim Cramer talks about it. That's anything over 4 is overbought, and we hit 5.7 on that yesterday. So we're due for a little bit of consolidation, and that'll be good. I mean, a 2,000-point move in the Dow over 2 weeks is almost it's parabolic again, and we don't want that. We'd like to see this thing churn a little bit higher, but the technical indicators look good on the S&P. Again, we're a little bit overbought for this consolidation. It should be right in line with what we want. Here's the NASDAQ. It has bounced back a little bit further. As you can see, once we crossed that 61.8% retracement level, it started to take off, and we're almost back to the old highs. We're probably within about 1% or 2% of the all-time high. Indicators still look good. It's getting a little bit overbought, but not crazy yet. So this, again, looks like we're going to take off here. I don't think we'll have once we break through this 7,500, we can take away what could be a double top. So keep your eye on that. Here's the NASDAQ advanced decline line.
Looks like the audio.
The audio was so bad I couldn't understand. Has the audio improved now? Can somebody let me know?
Seems better on mine.
Let's see here. It's awful on my desk. Yes, better. Linda says it's better too. Jed says it's better. Okay, I'll keep on going then, and hopefully we got that straightened out. Again, here's the NASDAQ advanced decline line. Again, we're showing some good broad participation. In fact, I meant to mention this on the New york. As of yesterday's close, the NYSE AD line was at 410,355. It topped out in January at 413,302. So we are only about 3,000 units off of the New York, making another all-time high, which is a bullish. Somebody's moving stuff around on the screen here. But anyway, that'll be another breakout thing and a bullish thing for us to take a look at as the NYSE AD line keeps moving forward. Here's the NASDAQ new highs, new lows. Again, we're seeing some expansion in this. We hit triple digits 1 or 2 days already. Again, we'll see this thing coming back up here around the 200 if we're going to have another fresh leg up. And we'll talk a little bit about that. Here's the Russell 2000. again, yesterday we got above the 50-day. Now we actually earlier this morning we broke above the 38.1 percent retracement, or 61.8. Sorry about that. We've backed off a little bit now. In fact, we're just sitting on the 50-day moving average today with that. So we'll kind of watch that a little bit. If it bounces off of that a couple of days, that's fine. Again, it's a little bit of consolidation from this big move up is expected. The indicators all are looking that we should have higher prices. Here's the transports. Again, they've also just today we're breaking above the 50-day, but they're struggling a little bit today. They're down about 79 points. So we'll keep an eye on that. The indicators are still bullish. They're getting some strength. Momentum's picking up a little bit on that, and some of the industry groups in the transports look real good right now, especially like the airlines and some of the freight companies. Here's the semiconductors. This is what I wanted to show. This you want to look at this thing, make sure we don't have a double top on this. But I think we cracked through about 13. I think it's 85. We'll be breaking out to new highs for a fresh leg up. Today it's almost flat. We're at 1380. So I would expect to see semiconductors, which is right now the strongest industry group in the whole market, break out of this, break out to a new top, especially have a point and figure buy breakout and everything on that too. So we'll watch that. All right. Now this is a chart that we usually don't bring up. This is the yield on the 10-year Treasury. Now the reason I brought that up is because basically anything that's going to happen in the market going forward for a while here is going to trade off of this chart. All right. And instead of bringing the bonds up, I brought up the yield itself, because if you're not really familiar with it, when bonds go up, yields are going down. When bonds go when bonds are going down, yields are going up. So in this case, the bonds are coming down, but the yield is going up, and we're right over here, right around yesterday we were around 2.85. This morning we've moved back up to 2.92, which is almost the old high. Now, what's going on today is you have the new Federal Reserve Chairman Jerome Powell talking before Congress. I wish Congress members would know what the Federal Reserve actually did before they asked all these questions about policy and Trump and everything else that he has no control over. But anyway, this is a 5-year. This goes back 5 years, and what I wanted to show this is back in January of 2014 was the last time we actually hit that 3% level. The traders are watching this right now, because if inflation comes in a little bit hotter than we expect, or some of the economic data, there's supposed to be a lot this week coming in, is hotter than expected, then we can see this thing break out above 3% and maybe hit that 3.1, maybe even 3.12, somewhere around that. If that happens, you're probably going to have a sell-off in the market again. It's even possible that that maybe this other little sell-off we had in February was just a warning of this thing going up too high. But right now, over the last couple of days, we got up here, that's 2.95, and then it was kind of eased back a little bit. Of course, with the Federal Reserve Chairman talking, he's moved it up a little bit because he has to seem, like he's on top of everything. I wouldn't expect him to do much of anything here. They'll raise it probably in March a quarter point, that's expected, but I think he'll kind of talk things down a little bit and just say he wants to remain gradual, because he doesn't want to be responsible for crashing the market his first month on the job. So, just keep an eye on this, because something could come out here where maybe GDP or something like that, or consumer prices come in way hotter than expected, and this thing gets a pop. You're going to have a sell off in the market. How deep? I don't know. Maybe it just goes back and retests where we were at. But everything that we do going forward for a while here, until this settles down, we'll trade off of this chart. Unfortunately, we don't have these on the smart chart in Market Edge, but you can find these on different places. So I think Yahoo Finance and stuff will have that. But so keep an eye on that. Again, this is what we're going to be trading off of. Ideally, what we'll see on the 10-year Treasury, we'll see the thing settle in between 275 and say 290. If we can see that, the market should be able to move a little bit higher. Okay, I'm going to show you the next slide that we have, making money in a bull market. again, we've talked about this for the last 3 or 4 times. Why is the market going up? Tax cuts, deregulation, infrastructure spending, global recovery, expanding earnings, which should still continue to expand for the next 2 or 3 quarters. And now we had a reasonable valuation on the S&P 500. It's starting to move up probably now to about 17.5. It was about 19.5 back in January. Okay, what could go wrong with this thing? Again, we just talked about, we get an inflation spike, maybe low employment causes wage inflation. The market isn't cheap. We've kind of taken that one back a little bit. Of course, you go into a war, the volatility gets too much, but that's been backing off. We were down below, we were 1580 yesterday. We bounced back up today, but a lot of that's just because of Powell talking here. And then, of course, this trade war with China or NAFTA would also cause some problems. But as of right now, none of these are quite. I would say that we're okay right now. We're not at a point where we're looking at these things going, hey, this is going on right now. We need to get out. All right, this is another one that I haven't done. And this was due to a question that came in this week. I'm not a big believer in, or follower anyway, of the Elliott wave theory. So somebody asked me a question that says, what do you see here if in Elliott wave? And I'll take a look at it just to see what it is. Elliott wave it means that it's an indicator that says the market's going to move in three or 5 leg movements. So going back to January in 16, I thought this would be 1. This little sell off here, which would be a 3, would be 2. All this move up to here to me would be wave 3, which is the strongest wave and the longest wave. This would be what we just had now would be wave 4. And generally after wave 4, you have another wave 5 that goes above the top of wave 3. It can be as long as number 1, or you can take the number 1 and multiply it by some of the golden ratios and get if it starts to outperform this. But that's the case, and you're looking at probably around 3,000 on the S&P 500 as our next target going out maybe into the summer. But again, one thing about being a CMT is you don't follow everything, but you have to learn about everything. Just so if you have a discussion about it, you can talk about that a little bit. All right, another one we want to look at, which is kind of important here also. This is the 5-year crude oil chart. Now, if you go back through here, this is where we went bullish last August. We broke through that trend line. We started getting into the oils here. Our target was 60 to 62. We hit that. We actually got up to about 64, 65, almost 66. We thought, okay, $70 our new target. That would be a 50% retracement from this back line back here in 2013 down to the low. Today we're backing off a little bit. We're down about 2% on oil. But I think right now, I'm not sure if we're going to get to that 70 level or not. It's possible. You have a little bit of negative divergence in here. I think what's more likely, the U.S. dollar is helping us bounce back. And in fact, I told you 2 weeks ago that if we break through that 62 and then we don't hold 60, you want to probably get rid of your oil. Well, we actually went down to about 50, 58, 57 something intraday, and now we've bounced back. Part of that again is because of the U.S. dollar. Part of it also is just the fact that the correction in the stocks may be over. That's also helping crude oil a little bit. So my opinion on this is I think we're probably going to be in a trading range anywhere from this level down here around the 150-day moving average, some of that area, from about 55 to about 65 for a while. And if we can do that, the market will be fine with that. You can still make money on the oil stocks. Right now, if you did come out of them after this move, you made some money, and if they come back down here around the 60 or 58 level again, maybe we could add to it. But you can see the accumulation is still going on. So it looks like we could probably go a little bit higher in here. I don't see it going much higher than the 70 tops, and the reason for that is because we get up there around 70. The U.S. drillers come on board, and they'll flood the market even more, and that'll keep a top on prices for right now. Now, the reason you can still make money if you don't have much of a movement on that is the oil companies have retired so much debt that their earnings this year and probably next year are growing like anywhere from 50 to 100%. because they were all losing so much money over in this period over here. All right, now this is another chart we want to look at. It's a little bit what you wouldn't expect. This is the ETF on the U.S. dollars, UUP, which you can find on our charts also. We've talked about this thing before where we wanted to hold around that 24 level back in here. We did, bounced above it, and we came back down. We broke through 24. Now we're down here around, looking at just about around 23 on this thing for support. This thing breaks 2284, 2285. Something could be wrong. I've seen a little bit of, the selling's kind of receded on this thing. It's not the momentum's not positive yet. But if we can hold this area around, right around this 23 and a quarter, I think we'll be fine. That's still keeping a bit under oil. It's also keeping a bit under commodities, which are probably are in a new bull market. They've broken some long-term trend lines to the upside, and some of the material stocks and the mining stocks, I think, are places where we want to have exposure. But again, in a rising interest rate environment, you would expect this to be moving up in this area, and it's not, which is a little bit troubling. I'm not sure why. I keep looking for other people to talk about it, what they see. Part of the reason may be that because Japan's economy seems to finally be coming out of a 25-year flat growth. And I think you're seeing a lot of money going into that area. Part of the euro is a little bit stronger too, with them coming out of their recession. So that's probably keeping some downward pressure on the UUP. But I would still expect hopefully this is bottomed right around here, and we can see this thing trade a little bit of a range between, say, 23 and 24 area right in here. That would be good for the market also. All right, so you're looking right now. It looks like, again, I think that we're probably out of the woods here on this thing. We'll keep an eye on the different moving averages. We'll also keep an eye on that 10-year yield, because that's how the market's going to trade. So we talked a little bit a couple weeks ago also about when you see a snapback rally like what we had, what am I going to buy? You could go into the industry group and go by relative strength, but that's over the last 50 days. So that may distort your some of the groups. What you want to try to do is find the groups that are still improving or strong, but over the last 1 week they have outperformed. And that's what we're looking at here. Now, on the new site, most of you should be getting pretty familiar with that. When you go into the industry group or ETFs or some of your stock watch lists, anytime you take your mouse and you go over these group names, the chart's going to pop up. Okay, so in this case here, you see steel, semiconductors is up there, aluminum, here's internet content, internet retail, diversified mining. These are the industry groups that are bouncing back and are the strongest. So you look over here, they're strong, improving strong. That's what you want to look for stocks in that group. Click on the group, you'll find the list of the stocks. All right, here's this is, I'm sorry, that was by the 50-day relative strength. Now this is, okay, I'm sorry. This is the number one bounce back on the industry groups was semiconductors right now. So I clicked on that. And what we're going to do now is look at the relative strength and the score and the opinion on the semiconductors. And you go down here, you want to look at the stocks that have a 0 score. You have NVIDIA, NXI Semiconductor, Qorvo, Skyworks on semiconductor. We're going to look at that one a little bit later on. And you'll get a list of the stocks that are bouncing back. You also go over the symbol, and you get the chart, so you can just see. Not only do you see that they're long, but you see the chart's strong too. If you want to do some more research on a list of these stocks, if you make a stock watch list and then just come back in here and click that little plus sign, it'll enable you to take maybe 15, 20 stocks, put them in a list in stock watch, and that way you can go right back and start doing a little bit more research. In addition to that, when we upgrade or downgrade the stocks that you have in that stock watch list, you'll get an email the night before that'll alert you that something has changed in that. All right, I want to look now real quickly at a few of the different industry or sectors. We talked a little bit about what you want to be in. Here's the technology sector. Today, we're actually breaking out to a new 52-week high. That's fast. It's basically on the strength of semiconductors. And not only that, if you look at the industry group, computers and information is strong. Diversified technology is strong. So you have a lot of groups that are participating right now. That's one of the sectors that we still want to remain in. We want to be buying, putting money to work in that. Indicators are all bullish. The next one here I still like is healthcare. We bounced off the 200 of that. We've retraced more than 50% of that. Then we've crossed over the 50-day. A lot of this also will be due to some of the biotechs that are going to be strong. I still think you want to own a little basket of biotech stocks. Okay, industrial, or here's the financials. Rising rates, the financials are going to outperform. Here's you can see all the indicators are bullish on this. We're getting close to retracing the whole amount from the sell-off in February. That's strong. I would continue to see that go into the industry group, and you can find some of the different stocks in that. That's not just the big banks. This also includes insurance companies, which are one of the strongest industry groups today. Healthcare providers are in there today. Investment services, some of the brokerage firms, Goldman Sachs, LPL, the online brokerage firms, TD Ameritrade and Schwab and all those are all part of this group too that you want to own. All right, here's the industrials. Again, we've taken out that 61.8% retracement, heading towards the old highs again. Indicators look bullish. One thing we do want to look for in this thing, if the 10-year does start, pushing up here around 2.98 or something like that, then it's probably going to 3 anyway. But you want to make sure we don't get up here, this thing, and we start seeing negative divergences where this thing makes a new high and you start seeing the 14-day RSI only gets to maybe 70, or the MACD histograms, are below where they were back in here. So keep an eye on negative divergences. Obviously, we'll talk about that if we start to see those over the next week or two. But industrials, they have a lot of things going on. The infrastructure stuff is going to be good for them. Tax cuts are good for them. The repatriation of money coming back will all be good for these. These companies are going to either raise their dividend or they're going to buy back stock. Either way, it's good for us as an investor. Okay, here's the consumer discretionary. That looks good. Having a weak day today. Again, we've done the 61.8% retracement. We're having sights on the whole old highs again on that. I think you'll see that. You want to see this momentum pick up a little bit more. But all these the box stores have had a great run. And they're propelling this thing over. Macy's had a pretty good report today. I don't know if it went up or down, but you're seeing some, all these box stores move ahead. Here's the energy sector. Now this is also a little bit strange with crude oil going up. This has bounced. It held the 200-day moving average, which was great. Now we've gotten up to the 100-day. Because of that, I still think I would think that some of these energy stocks are going to start to outperform going forward, especially if we get through this little V-shaped recovery thing. We start to see the market head higher. You could see some of the energy stocks again become leaders in here. The sell-off wasn't too bad. You're getting ready to go positive on momentum on this thing, but keep an eye on that. If we cross over the 100-day, we could get some higher prices in that. Here's materials. Yesterday we crossed above the 50-day. I do like the materials going forward. We're right there at that 61.8% recovery on that. So if we break through that, that'll be bullish on that. We're getting some positive indications on the indicators. Again, with the infrastructure building, this is one of the places you want to be on there. I'm not going to go over the consumer staples or the utilities. If you like those, or the REITs, if you like those, they've sold off enough where if you want to own some, you're probably getting a decent price on it. I just don't I don't think you're going to get much growth besides the dividend on those things while rates are starting to go up. Okay, I'm going to go a couple different stocks. If you have some questions you want us to put in here, put them in now. We have about 5 or 6 stocks that came in. And rather than just go to a chart and talk a little bit, I wanted today to go over a little bit of the second opinion with you so you can look at these things yourself. The questions were, should I do, are these stocks that need to be sold? Here's Accorda Therapeutics. I'm a little bit familiar with this one because I owned it over in here. And this big fallback in here, was where the FDA told them that they wanted further review on a drug. It's, shows the volatility and why you want to own more than just one of these things. But the fact that this thing has bounced back so quickly is actually very bullish. That means the guys that really understand the therapy or whatever they have on a Corda mean that they think that the results that they have so far are good. This would be one that I wouldn't be looking to sell. So you go over here and you look at the second opinion. We do have a long power ratings in 84. That's good. The C rate is 8.5. So this thing probably has another 15 to 20% more of the upside based on short-term momentum indicators. So I would not be selling this thing. I would probably be looking to maybe add to this if we get a pullback here in the next couple of days. All right, so then the recommendation, stocks a buy, and then you'll get your comments over here. It says, is it a strong uptrend? Look at different indicators. Okay, here is American Axle Manufacturing, AXL. Okay, do I want to sell this thing? Okay, we went to on 227, which I guess was today. Yeah, 27. All right, 27 over in here. We went to a sell on this thing, and it's continued further down. It was trading at 1648 at that time, and now we're at 1575. Are we trying to find a bottom in here? I don't know. We're below the 50 to 200. This says it's a short candidate, and the C rate is about 5, so it looks like we have 10% more downside on AXL. Today we're, sorry on this thing, what's it doing today? We're down another 40, so 1557, so it's gone down further today. After a move like this, I'm not so sure I want to short it. However, the industry, auto parts and manufacturing, they don't seem to have confirmed the V shape instead of the W shape. Entry point. Okay, Daniel, I'll get to that in a little bit about the V shape versus the W. But anyway, on this one, actually, I would, you probably should have sold it over in this area, and I would see if it breaks through that on the point and figure. You could probably take a look to see where the next level of support would be, and it's probably down here in the 14. So I would probably steer clear of this one. Now, here's Amcor Technology. I have been familiar with this in the past. Again, this is another one that was upgraded today. So we have it says it was upgraded to a neutral from an avoid. So it's not quite an early entry candidate yet. However, once the up-down ratio turns up, it will go into that, and we'll give you the price down here where it says early entry, where the buy stop is on these neutrals. That's going to be the point when it trades above that. That's where you want to go into as far as front running the system and going long. So in this case, there's a little bit more work to do. Kind of watch it in here as far as what the stock's doing today. It's down 12 cents, 10.30. So we're sitting right around down in here today. So keep an eye on that thing. Again, it's starting to improve. You may want to wait to see if what the buy stop is on this thing before you actually pick up on it. And if you do front run some of these things, sometimes it's easier if you just buy a half position and then you can buy the other thing. All right, here's Wells Fargo. This thing was actually downgraded today. Out of the banks, this is probably one of the worst acting ones, and that's just because they've got a lot of internal problems right now. I think long term, it's probably a good one. If you could get this thing back down here around the 200-day moving average, sure, it'd be a buy. Wells Fargo today is down about 20 cents, so it's hovering right around this area. Again, you've had a pretty good correction on this thing. I would maybe watch the market in general for a little bit, and if we start to move up, I think you can go ahead and buy it. You've had a pretty good pullback. You're able to get this thing. See, it was up to 66, almost 10% off of its high. So I don't think it's a buy at this point. It's just got downgraded, but you might want to put this on a list and put it in a stock watch list and see when it gets upgraded to an early entry buy. On semiconductor, again, you're in the number one bounce back industry on this thing. I think that semiconductors were up over 3% over the last 5 days or so. Looks like it's breaking out to new highs. You have we went long again. This one here we went long last August back in here, and it stayed long. So that's a good thing here. The scores are -2. You've had a little bit of deterioration, which is reflecting this. But once you're moving ahead on, moving up to the old highs, you're seeing some improvement in the different indicators, especially the MACD short term, which means the short term trend is bullish also. So when you see these things, that's what you're going to look for. You can find some trend line resistances down here. You can find support areas on the second opinion. You should be able to, when you see the charts, just kind of put that in yourself, and you can see it. You can also, if you click on this thing, you'll get a 6-month chart, which can also help you find some entry and exit points. All right, we got a couple questions that have come in. Let's see here. I think it's Daniel. He wants to confirm what's confirming that we're having a V shape instead of a W shape. What's confirming this right now, and you don't have a real confirmation. Remember what I said earlier, everything that we do for the next, could be 3 weeks, could be 4 weeks, is going to be based on that chart on the yields. All you have to do is keep that on the 10-year Treasury. We're at 292. If it gets above 3%, we're going to have at least a W. If we can sit here and trade back and forth between 293, 294, then come back down to 285, and that area sticks back and forth, we're going to break out the new highs. What the market doesn't want, the uncertainty. So if we can get a little settling of the yields, that takes away that uncertainty, and then traders will be more comfortable about going in and picking that up. However, again, if we do have that, if we go above 3%, you can I would look for that W recovery rather than the V. But until we do that, I think you nibble away here and just be kind of quick, kind of stay nimble, and also you come in here one day and that pops up to 3.1, then you take your profits on there and maybe take a short loss. Remember, one thing about buying stocks and being a little bit active, you only need to be right about 45% of the time. If you're right 45% of the time and you let your winners run, you can have 55% of the time you can be dead wrong, and if you take some 5 and 6 and 7% hits, no big deal. You want to conserve your money and can keep it there, and then you're back in the game when the thing does sell off and you go back in. So again, I'm nibbling away in here. I'm putting money to work, expecting this thing to make new highs. But if I see the 10-year hit 30, I'm out. I'll sell off. I bought some stuff down in here. Some of the banks. Bank of America was at 28 and something, and it's at 32 now. So there's some pretty good trades off of this so far, and I'm still holding some. Again, and we'll go from there. I'm looking at some of these other charts. All right, I'm going to go ahead and share the screen now because we have some more coming in here. So if you'll just bear with me for a second. I'll get to them. Okay. All right, let's look at first off here. There's a question on Walmart. Now, I like Walmart over the long term because I think they're one of the few that will be able to maybe make a niche in the Amazon. A couple of things that they're sticking out right away that actually are good. First off, we have this gap that took place over here. Okay, what technicians look for a lot of times is when a stock gaps up and it comes down, is it going to test that gap and does it hold? Okay, if you're trading Walmart, any area right around here is a buy. You break below this, where the gap was over here, and breaks below that, then you're going to go down here at least to the 200-day, and at least check on that. So that is giving you a sign to me that okay, we filled that gap. That's a bullish sign, especially if we start to move up and take out this let's see, what is it? The 100-day moving average. You'll get more institutional buyers coming in, and once it gets above 98, then they're looking at this gap to fill. So I like that. It's actually oversold in here. You can see this thing's down below 20. You may want to wait till this thing, the 30-day stochastic moves above 20. A lot of selling, but you're seeing some people starting to nibble on this thing here. So again, my opinion is I would be a buyer of Walmart down here, at least starting to nibble away. All right, Hasbro. Okay, another one that kind of came back, kind of a nice little rounding, it says has a little bit of a rounding bottom. The toys, thanks, because of this one, are actually because of the gaming stocks, are one of the stronger industry groups, but again, it's not because of Hasbro and Mattel and things like that. It's because of Electronic Arts and Two Active, that type of thing. But you have some nice accumulation in here. Again, you've got an awful big. You've been trading in this zone here for. Let me do a little drawing on here so you can see what I look at. Okay, so we have this. So we have this area right through here. I'm going to take this throw over and right through here, where you have this trading zone. You have the upper band of this sideways motion here. I would say if I really like Hasbro, since we're trading around 97, 98, I could wait till we're almost to 100 to buy this. I want to see the MACD start to turn up. I'd like to also see the MACD, the 14-day RSI, maybe pitch up here around 60. The second opinion on it is, see what they have right here. Okay, it's long. This has a lot to do with it going long, but we had that big gap up, came back down, and retraced about 50% of that. Now we're struggling to hold this 200-day, but that's a bullish sign. Again, I would just like to see a little bit more momentum in the stock before I would go into it. If you start to see that and the whole market looks good, you can probably get a little bit of move up on this thing. Not great. I'm not looking for it to go up to its old highs anytime soon, but I think you can get a trade for a couple of bucks if you want to. Another question: the daily versus the weekly, the difference in the second opinion. All right, we get that question a lot. And if you have a Schwab account or a TD Ameritrade account or an E-Trade account, you on their research platforms, you will get you get for free. You get the second opinion weekly, and I got to tell you how I use. People use that two different ways. Number one, the weekly is a much more conservative model. It's a slower acting model because the indicators are smoothed out over a longer period of time. I myself, when I do my portfolio stocks, that I want to, that I don't want. I'm not looking for a 2-3 week trade. I want to hold these things through the gyrations. I don't want to be going long over here, then getting out over here, and then I got to go long over here, and then selling over here again. So the sideways market, since second opinion is a trend following model, you're going to get whipsawed around. I use the weekly model for exiting. When I exit a stock, I have a couple different things that I use. It gets downgraded by the weekly model because that's going to keep me into these swings like this, okay? Because it smooths this action out. And I also will sell a stock once if it falls below 1.0 or actually about 0.98 on the 50-day relative strength, and it trades below the sell stop. But for my holdings that I want to do, and I'm not a 20-year-old kid. I got to hold on to my money. I want to those are my two exiting positions on the things that I pick up for my long term. Okay. Now for shorter term traders, the daily second opinion exits are going to be good. It's going to give you all the short term resistance and support areas and breakout that you're going to want. Okay, we have another one over here, MTN. Familiar with this one a little bit too. Is this the Vail Resorts or something? Yeah, Vail Resorts. Okay, this is you got a double bottom here, which is good. You go in here, you've had that. Are you gonna come down here and again? I would keep an eye on it. I don't. You have a little bit of accumulation here. I believe these things are trading a pretty good. I'm trying to see if this is a REIT or not. I can't remember. It's not. It pays about 2%. This thing's not really acting very good. I would like to see this thing, break out to a little bit higher levels. And so some people say, well, if you like it, you want to buy it here, why don't you buy it at 200 rather than 215? That's not a big move. If I'm going to buy it at 215, it's because I think it's going to 250. And in this case, I don't see anything that's going to put me in there to buy the thing at this stage. I don't see anything really too much constructive things in the indicators. the only reason I'd be buying this is because it's a double bottom, and you want to come down here to see if it's going to hit this. You know, it might test support again at 203. So I would be on the sidelines and wait for this thing to get a little higher. We're right near 211 today, so you know you're not getting much of a bump on that thing either. All right, listen, I've gone way over again. My fault. I apologize for that. I do appreciate everybody taking time out of their busy day to join me. I do hope you got something out of that. Now, some of the charts that we looked at today that were different, we'll be looking at those again. And for the rest of the week, whatever platform you're using for your investments, make sure you keep that 10-year Treasury yield up there, and just keep your eye on that. Yesterday we had backed off 2 days in a row, so we got a 700-point rally. Today we bumped back up and reclaimed that. You're down 100 points. So everything that we do going forward over the next couple of weeks until that yield settles down is based on that chart. You know, we're not going to go to 3.1% or 3.05 and the market just not even bat an eye and go higher. It's going to matter. And so just let you know, keep that going, and we'll be back here next week and we'll look at it again. All right? Hope you got something out of it, and have a good week.